Hi, good afternoon. Thank you for joining us. This is Cordant's market update for October 16th, 2020. Today, we're going to talk about a few things. We're going to talk about the market year to date, just where we are. We're going to cover briefly some health and economic data. And then we're going to look at a question that we've been getting more and more lately, which is, do bonds make sense? In this environment, given the current rates, does it still make sense to own bonds? And so we're going to look at a couple things related to bonds there. Really quickly here on the market. So again, the path we've traveled so far this year, at least on the S&P 500, the largest 500 companies here in the US, dropped about 34%, had a recovery of 60%, and since then kind of been bouncing around. So down about 10% at one point from the peak just after the 1st of September, and dropped that 10% and then have bounced back. Last couple of days we've been down. Again, this is probably to be expected after a recovery like we had, for it to go sideways for a period of time. Additionally, with some volatility here ahead of the election. So that's the path we've traveled so far year to date. One thing that we touched on last time, wanted to revisit here, is just how markets outside of the U.S. have done compared to markets in the U.S. As you probably know, remember, U.S. has been best performing market of late. Doesn't mean we don't still think that there's value in being diversified outside of the U.S. for a host of reasons. One would be something timely like we're facing right now with an election and some uncertainty here in the U.S. Makes sense to have some diversification in markets across the globe. So just checking in, one point here is that 10% drop that we looked at previously. Markets across the globe were only down about half that. So really short time frame, but it does provide some perspective and some benefit to that diversification here of late. Checking in on some data, we don't have a ton of economic data that has come out lately. One story that's kind of been in the news more and more, and something that the markets are paying attention to, is the increase in cases of COVID here in the US and now in Europe as well, and them starting to roll out some more restrictive lockdown measures, Europe, France, and some other countries as well. So this is definitely something to keep an eye on. The other thing that the markets are paying attention to is, the stimulus talks here in the US, and those being delayed and not a lot of progress being made there. In terms of economic data, kind of a slow week, but we've talked about this before, the bar continues to be raised, so it becomes harder and harder to beat expectations. But from a services index level, still coming in better than expectations. Jobless claims actually came in higher than the consensus this week, which is obviously a negative. And then consumer price index. So this is inflation, something the Federal Reserve is watching very closely as it relates to their monetary policy, basically in line with consensus, although inflation, if you look at it kind of a month over month basis, has come down. There was a big spike after some of the stimulus packages hit, a bit of a temporary spike, but that has started to stabilize. In terms of the economic surprise index that we've looked at so far this year, basically our numbers coming in better or worse than expectations, and looking across all the economic data that's in this index. And what you can see is we can continue to fall back to that zero line, which again, it's a mean reverting series. You would expect that to happen, but it just shows that economic data continues to come in better than expectations, but not by as much as it did for a period early in the recovery. So that's where we are from a market, from a health data, from an economic data perspective. Wanted to spend a little bit of time here on the topic, the question that we've been getting a couple times from a few different people, which is, do bonds still make sense in this environment? Wall Street Journal had an article earlier this month and basically was asking this question. Bonds have always been a safety net, and people are fearing that they're not anymore. So wanted to, spend a little bit of time looking at, why do we own bonds in the first place? What's the purpose? And then kind of look at some of the risks of bonds. If you own bonds, when does that go poorly? When does that not necessarily work out? And then check in just kind of on where we are on some of those factors right now. So First thing we want to look at is just what's the purpose of bonds historically. There's about three factors, or I think buckets, that you could put this in. One is sort of the sleep at night factor. Bonds traditionally don't move around as much in price as equities, as the growth portion of a portfolio. And so, one of the factors here, one of the purposes of bonds, are they just simply help you sleep at night, allow for a more stable portfolio. So that's one. The other thing, because of that, because there's less volatility in the portfolio, because that portfolio wiggles less, moves around less, it actually allows you to increase your withdrawal rate. So if you're somebody that's in retirement and pulling money out of the portfolio, by building a more stable portfolio, you're actually able to take more money out than you would be otherwise. So if you have all stocks and one year your portfolio's up big and the next year it's down big, the consistent withdrawal rate is going to be lower, because when your portfolio is down big, if you pull money out at that point, you don't give a chance for that portfolio to recover or to bounce back because you pulled out spending. So the second thing that bonds help do is increase a withdrawal rate. And then they also provide a reliable diversification. Here we're looking at a chart over here on the right, and what you can see here is just correlations of several different assets to the S&P 500, and bonds are hanging out over here on the left. Right there, close to zero in terms of correlation, meaning they don't move together. Managed futures would be one of the other ones that are historically not very correlated to what is going on in the equity market. So three factors: help you sleep at night, help you withdraw more money from your portfolio if you're retired and pulling money out, and historically have been a pretty reliable diversification to stocks. So that's why we own them. Some of the risks of bonds when bonds don't work out well, three things really. Inflation. If inflation is high, or if it's coming in ahead of expectations, that is going to erode your returns in bonds. So bonds are priced typically what they call nominal returns, which means if you're going to earn 2% from your bond, that's the nominal return. But if inflation is 3%, you've actually had a minus 1% real return. You've lost money after inflation on that. So inflation tends to be bad for bonds. Default, also pretty obvious, is bad for bonds. So two types of risks that most people talk about with bonds are interest rate risk, which is inflation, and credit risk, which is default, that you don't get your money back at the end of the bond. Other risks out there right now are just purely low rates. They're expensive is another way of looking at that. And so one, you're not earning as high of a rate, but two, in a period where the markets drop, there's less income from your bond portion to kind of cushion the portfolio. So want to look at kind of each of these three factors and just give a sense of where we are today. So inflation risk, first one. Here we're looking at a series that's tracked, that's basically the Treasury inflation protected securities. So you can basically buy a security that's going to pay you more if inflation's high. Your return will be less if inflation is low. And they essentially just look at the break even, where this is the market prediction of what inflation will be, in this case, over the next 10 years. And what you can see here is it definitely dropped at the beginning of the coronavirus outbreak this year, and dropped to about 0.5%. Subsequently now has bounced back to a little bit above 1.6, 1.7%. So these are the market expectations for what inflation is going to be over the next 10 years. So a little bit below, but about right in line with that 2% target that the Federal Reserve has, and kind of where things have been more or less in the range since going back to 2016 at least. So conclusion here is, at least for me, market participants aren't pricing in a much greater risk to inflation. Given all the extra money supply, all the stimulus that we've done this year, market participants still aren't betting on getting some substantial inflation over the next 10 years. So that's where we are in that first factor, inflation or interest rate risk. Next factor to look at is default risk. So here what we wanted to look at is just looking at corporate bonds, which tend to have a higher rate of default risk than, say, treasury bonds, which pretty much universally are considered risk-free, no or very low default risk, which is also, as it relates to U.S. Treasury bonds, a question that we've got a few times recently, basically just based on how much debt the U.S. government has been issuing. And I think that's a kind of a topic for another one of these discussions. There's a few factors there that matter that we want to look at, but want to just zero in here on just the corporate bond yields. And again, what you can see is a very similar pattern here. So the spread, we're looking at how much yield corporate bonds were paying relative to treasury bonds. And what you can see is at the beginning of the crisis this year, those yields, the yield spreads really widened out. Pretty quickly corrected right now, about a 1.5% premium that a corporate bond, a AAA rated corporate bond would get over a treasury bond. Pretty much in line, maybe even slightly lower than the series going back to 2011, a little bit higher than we were at 2018, 2019, sort of at the end of this expansion that we had since 2009. So that's the second factor, default risk. Again, pretty much in line with historical norms here. The last one is low rates. Here, I think that there's a little bit of validity to this. So this is a pretty interesting study that was done. Study was called "Will Bonds Deliver Crisis Alpha in the Next Crisis?" Crisis alpha defined as months where the S&P 500 was down 5% or more. What did bonds do? Did they provide a benefit in those periods? And what the author did was tease out the income component of what bonds did in those periods versus the capital appreciation component of what bonds did. And what you can see here is split between all months, normal months, and what they defined as crisis months, again, when the S&P 500 was down 5% or more. You can see that in those crisis months, most of the benefits from bonds came from that income component. So thing to note here is as the income's lower or as yields are lower, you would expect, all things being equal, that you're not counting on the capital appreciation part, but just counting on the income component. That cushion gets smaller in an environment like this where interest rates are lower. So that's one thing to note. Two kind of follow-ups to that. One is just based on the experience this year, they did still provide a pretty good cushion. So what you're looking at in green is the intermediate term government bonds, just treasury bonds again, and in gray is the world stock market. You can see the big drop in March, April. Treasury bonds, did provide, even though rates were lower, did provide a pretty good cushion in this environment. You can see here that they did fall a little bit. Rates went up a little bit through this period, so they did fall a little bit, but pretty similar returns over the year for these two components. However, kind of the path is much different. The green, the bonds, did provide a big cushion this period. So that's one thing to note, that even though rates are lower, maybe the cushion is less than it has been in the past, it has still served that purpose of providing some stability to the portfolio. The other thing to note is investing is sort of a relative exercise. It's not just things in absolute, it's things compared to each other. And so if we want some of those benefits that we talked about earlier, be able to sleep at night, increase withdrawal rate, reliable forms of diversification, like what are our other options? And so this is something that we will continue to look at over time and research, what are the alternatives to bonds? But there's more or less a handful, and all of them are going to have some drawbacks or some trade-offs. So one would just be to increase your risk in the portfolio, own more stocks. If you don't need some of those benefits of bonds that bonds have provided historically, or you need them less maybe than you thought in the past. One option would just be simply to own less bonds, increase the risk in your portfolio. Another option would be, especially for somebody that's a little bit worried about maybe what's going on in the US, own bonds outside of the US. Again, here, there's some pretty big trade-offs. Yields around the rest of the world are pretty low. One of the benefits could be that you get some different interest rate regimes. So if interest rates go up here in the US, but they don't rise in some other countries across the world, you're protecting that interest rate risk. Another thing, bonds outside the US, emerging market bonds particularly, have more credit risk. So again, there's trade-offs there. Another alternative might be to own some lower risk stocks. So this is kind of combining the first thing, increase the risk, with what types of stocks. So maybe own some stocks that have lower risk, lower volatility stocks, maybe higher quality stocks. There, the idea would be to go from a 60-40 portfolio, 60% stocks, 40% bonds, to maybe you could get to a 70-30 portfolio, reduce your allocation of bonds to 30% and still get the portfolio at a similar risk level. So that could be one thing to look at. Managed futures, we saw that on the correlation slide. Historically, they've been pretty uncorrelated with what's going on in the equity markets, have provided some diversification during these crisis months that we talked about. And they did that this year. We do use these in some portfolios that we construct. However, that reliability piece is not always there. If the market drops sharply and then bounces back sharply, these things tend to follow trends and so might not respond to that. The world seems to be moving faster and faster. And so, there's some questions about, can these things like bonds tend to do provide sort of this reliable diversification in all kind of crisis periods. So that's one. Obviously, that comes with some trade-offs as well. These other two that I've marked in red, these are sort of ideas that are out there for alternatives to bonds, but come with, I would say, even more drawbacks or even more uncertainty or risk or higher trading or things like that. So one would be what's known as trend following bonds. So this would be only own bonds when times are good. So if interest rates are kind of stable or falling, you would own bonds. If interest rates are rising, you would get out of bonds and maybe own cash. So this is a bit of market timing or a bit of like sort of trend following with bonds. But that's one thing out there. Again, it increases that level of reliability or lack of reliability there. The other one would be something known as kind of dual momentum. So here you're switching between a couple things. So again, we looked at one of the risks with bonds was inflation, right? If inflation is high or is rising, it's not a good environment to be in bonds. So here you'd kind of do the same thing we were talking about before with the trend following, but on inflation. So if inflation is stable or falling, you would own bonds. If inflation is up, maybe you switch to commodities or something like that. So again, there are some alternatives. None of them come without risks and trade-offs and drawbacks. And so I think the conclusion here is these are things we're looking at, considering, but bonds still do play a good role in a portfolio in terms of risk mitigation, helping you sleep at night, helping reduce withdrawal rate, and providing some reliable diversification. So it's not that we're not looking at any of these other things, options, tweaks to the portfolio, but bonds do play an important role in a portfolio as we see it. So that's it. Most of this topic that we covered today came from your questions. So if you have additional questions, feel free to send them in. And thanks for watching and hope to see you next time. All right, thanks.